Want to unlock the secret to multiplying your wealth? In this video, I'll show you 3 proven steps to identify game-changing multi-bagger stocks. Let's dive right in. Step 1. Use an online stock screener. You can choose between different solutions. In this video, I've brought you 3 examples. First, the website Stock Analysis. Second, the website TradingView. Third, the website Investing.com. All websites are linked in the description of this video. Today, however, I specifically want to focus on the website Stock Analysis and demonstrate how you can find potential multi-bagger stocks using this stock screener. So now, let's visit the website together. If you follow the link in the description of my video, you will arrive at the main webpage of Stock Analysis. The website offers a free version that includes all the necessary functions we need for our purposes. Therefore, you do not necessarily need to register here. To access the stock screener, click on the Stocks category and then on Stock Screener. This will open this interface, where you can apply various filters that will subsequently refine your results list. Which filters we use exactly to identify potential multi-baggers will now be explained in Step 2 of my video. Step 2. Fundamental Analysis. Here, we focus on various metrics to evaluate a potential multi-bagger. The first key factor is the growth of company revenue, net profit, and earnings per share (EPS). This growth is typically expressed as a percentage, and generally, the higher, the better. Next, we examine the price-to-earnings PE ratio, which relates the stock price to the company's earnings. As a rule of thumb, lower is better. Values below 10, especially when coupled with double-digit percentage growth in revenue and profit, often indicate that the stock is undervalued. The next metric is the price-to-book PB ratio, which compares the market value of the company to its book value. Here, the general rule is that lower is better. Values below 1 indicate that the company is trading below its book value, suggesting it may be undervalued. Values between 1 and 3 suggest a fair valuation. The next metric is the price-earnings to growth PEG ratio. This metric compares the stock's price-to-earnings PE ratio to its expected earnings growth. Here too, the general rule is that lower is better. Values below 1 indicate an attractive valuation. The next metrics are the enterprise value to EBITDA and enterprise value to EBIT. These metrics generally provide insight into how long a company takes to generate its own enterprise value. The first of the 2 metrics compares the enterprise value to operating profit before interest, taxes, and depreciation. The second metric compares the enterprise value to operating profit before interest and taxes. For both metrics, the general rule is that lower is better, with values below 10 indicating an attractive valuation. At the conclusion of Step 2, we focus on the future prospects of the company. Here, the focus is primarily on the projected revenue and profit growth, but also on the business model, with questions about its sustainability. For example, how does the management view the future of the business model, and how does the market perceive it? Is the company fundamentally well positioned for the future to continue growing? We now return to the website of Stock Analysis and will use the evaluation metrics explained here through filters to identify interesting stocks. Now we are back in the stock screener from Stock Analysis, and as you can see at the top, I have set the filters according to the valuation metrics we learned in Step 2. In the upper section, you can see the metrics for cumulative revenue and profit growth. I have specified the growth at over 10% each for the past 5 years. Below that, you can see the other metrics. I have not specified these metrics in detail yet because it might happen that a particular metric is missing from the list we will review further down. If you apply a specific filter and the metric is not included in the list, the company will automatically be excluded. As a result, there is a risk of accidentally overlooking a company with great potential. So, if I now proceed with these filters and, for example, set the country to Canada, I get 14 stocks listed in the overview based on these filters. I want to specifically focus on the company Dynacor Group, which is now slightly highlighted. If we take a closer look at the row, you can see that the company has achieved double-digit cumulative percentage revenue and profit growth over the past 5 years. This is a very good sign and indicates that the company has a resilient business model. In this context, we can see the other highlighted metrics, which are also rated as favorable. As you can see here, the price-earnings to growth ratio PEG is missing. However, you can easily calculate it yourself by doing the following. Take the current price-to-earnings ratio of 8.45. Then click on the company symbol here, go to Financials, and navigate to the row for net income growth. This figure represents the growth rate for the third quarter, specifically September 2024. we can reasonably assume that the company has further increased its profit in the fourth quarter as well. However, for simplicity, let's assume a profit growth rate of 25%. This means you would divide the 8.45 by 25, resulting in a rounded value of approximately 0.34, which, according to our valuation system, indicates a favorable valuation. Then, I go back to the list and see what we aim to identify as a whole, double-digit cumulative percentage profit and revenue growth over the past 5 years, combined with fundamentally favorable metrics, such as a single-digit PE ratio. Now that we have checked off the valuation metrics from step 2, I always recommend also reviewing the stock price performance, which we can see here. I would always start with the 5-year chart, and we can already see that the stock has made significant gains and shows consistent growth. This is a very good sign. Additionally, I would also examine the maximum chart. Here, too, we can see that the stock price has significantly increased over a long period. Of course, there are fluctuations. Volatility is always a factor when investing in stocks, but if you had held on in this case for the long term, your patience would have paid off significantly, and we can ultimately refer to this as a multi-bagger. Naturally, the numbers we have analyzed so far are not sufficient to make a final purchase decision. What is still missing at this point are the future prospects. For this, I would always recommend visiting the company's website directly. Under Full Company Profile, you will find the link to the website. If we click on it, we will be redirected to the company's website. From there, we go to the Investors section and select Financial Reports, where you can find the latest quarterly report. At the top, you will see the financial data, and below, there are more detailed discussions. So, I will now click on Read More, check the table of contents, and you will see under Item 11 the follow-up outlook for 2024. This is exactly what it's about. How does the company assess the coming months, and ideally, the next fiscal year or even the next few years? In the best case, we also see here that the management expects further revenue and profit growth, which would ultimately likely lead to the stock price increasing in the future. Now, we have officially completed step 2, and further I would like to share a few important pieces of advice with you that you should consider when investing in individual stocks. So, let's move on to the third and final step of my video. I would like to conclude my video by adding a few investment tips. Let's dive right in. Do a comprehensive research on the company. As mentioned earlier, the data from a stock screener alone is not sufficient to make a final purchase decision. You should always take the time to learn more about the company's business model, its products, or its services. Ask yourself whether you understand the company's business model and how it generates profits. Review financial reports and compare them with the data from the stock screener. Research the management team and at least skim through some of the press coverage from the past few months. Invest for 5 years or even better for the long term. Always maintain a long-term perspective. This aligns with the dynamics of the stock market. In the short term, meaning 1 to 2 years, the market is influenced by psychological factors. In the medium term, 2 to 5 years, it is shaped by geopolitical, economic, and monetary policies. However, in the long term, the stock price is driven by a company's fundamental data. For this reason, stock prices always follow a company's fundamentals over the long term, making it crucial to take a long-term position when investing. Always invest in already profitable companies. Additionally, these companies should not have reported any losses in the past 5 years. This aligns with my previous advice. Investing in unprofitable companies carries a high risk, as in this case well-performing stock prices can plummet drastically due to a single negative event. Invest in approximately 20 to 30 stocks. There is no universal or definitive formula for this. However, you should definitely avoid investing in just 1 or 2 stocks, as this creates a high concentration risk. Diversify sufficiently, but avoid over-diversification. When analyzing the company's profile, focus specifically on its future prospects. I've mentioned this point before, but I want to emphasize it again because it is extremely important. You need to ensure that the company's forecasts are positive, meaning that future revenue and profit growth are expected. A positive development in fundamental metrics is highly likely to lead to a continued increase in the company's stock price over time. Finally, your own mindset is also extremely important. You need to keep your emotions in check. Stay true to your strategy, invest regularly, ideally in an automated way, and don't let yourself be influenced by expert opinions or other external factors. That's it for this video. Thank you for watching, and I hope you can successfully apply many of the topics discussed here to your future stock investments. Always remember, finding successful companies whose stock prices multiply is not a matter of luck, but rather the result of thorough analysis and sticking to a carefully chosen strategy. If you enjoyed this video, please give it a like, feel free to share it with others, and consider subscribing to my channel. See you in the next one.